Okay, in this video we're going to start to look at some of the factors that influence the level of aggregate demand. So we're talking about things that are likely to shift the demand curve either to the left or the right. First of all, when we're talking about movements along the aggregate demand curve, the thing that will cause changes or movements along, or contractions and expansions along the aggregate demand curve, are changes in the general price level. So the general price level is an aggregate measure used by economists to indicate how the average price of goods and services are changing, so whether the average basket of goods and services is increasing or decreasing. And basically, if the general price level is increasing, that's an indication that an economy is experiencing inflation, which is basically a measure of the percentage increase in average prices over a period of time. So in any economy, there is an inverse relationship between the average price level and the level of aggregate demand. The higher the average price level, generally causes a reduction in aggregate demand. In terms of the impact that prices have on spending, so this is the reason why the curve is inverse, increases in the general level of prices will reduce the purchasing power of economic agents. So the first reason why at higher prices we don't produce and consume as much, or demand as many in this case with aggregate demand, is that basically any value of a given income, so any real value of income or people's real value of wealth, is decreased when prices increase. So, for example, if you've got $1 million worth of wealth, if a country is experiencing high levels of inflation, the real value of that wealth is now decreased. So people's purchasing power is reduced when prices are high, and that can lead to a reduction in the overall level of spending. So falls in the general level of prices result in greater purchasing power. People feel richer because the value of their assets in real terms is now higher, or their wealth is higher in real terms, and they're likely to spend more. So increases in the general level of prices reduce people's purchasing power, one, because things are more expensive, and two, because people experience reduced real wealth. Higher prices also reduce our international competitiveness. So if our inflation rates are higher than other countries, that can lead to a reduction in demand for Australian exports, and we buy more foreign imports. So it's important to recognise that when prices are higher, not only do we export less, but Australians are more likely to substitute away from Australian products and into foreign imports. And when we buy imports, that doesn't have the same impact on our aggregate demand as buying local products does, because it gets deducted from the aggregate demand equation. So when prices are high, there's generally an increase in leakages relative to injections. That's one reason why import spending increases in a peak, because prices are high. So it's important to recognise that at higher prices we also spend less because there's less exporting and more importing. Okay, shifts in demand side conditions are things other than price. So when there's a change in macroeconomic demand side factor, that means that buyers are buying less at any given price, that means the demand curve is shifted to the left. And a demand curve shifting to the right means that consumers are more willing to buy products at any given price. And that will lead to an increase in real GDP, assuming that we're not already at our productive capacity, if I was to draw the supply curve. So the relationship between real GDP and general price levels, generally the lower the price, the higher the level of real GDP. But whenever there's an increase in aggregate demand, it boosts real GDP, assuming the country is not at its productive capacity. If we're assuming we're not at this vertical section, then any increase in aggregate demand will lead to more production to meet that demand, and therefore an increase in real GDP. So now we're going to look at some specific demand side factors. So demand side factors refer to any factor that causes a change in economic activity because it changes the aggregate demand curve. So we're looking at things that influence the level of consumption, investment, or net exports. So whenever I talk about each one, I will link it to the types of aggregate demand that it impacts, and you really need to articulate that in your answers. So you need to be able to say that it impacts this component of aggregate demand, and then it flows on to increased aggregate demand in the economy. So the first one is disposable income. Okay, increased disposable income will benefit aggregate demand mainly through the consumption component of aggregate demand. So when you're defining disposable income, it's the reward that's received by households from their direct, which basically means the money that they get from their labour, which is generally a wage or a salary, but it also includes their indirect income, which can include like rent from land or capital gains from earning a property or any interest they get on the bank. So disposable income is the rewards from both working and indirect income that we get from other sorts of factors of production, plus government transfers. So what I mean by that is any money that we receive from the government for like welfare and things like that, minus any direct income taxes. So in Australia, that's our progressive income tax. So it's all rewards from working, which we generate wages and salaries, from any other indirect sources like interest and dividends and capital gains and rent, plus any government transfers, so any money we get from the government, minus any direct income tax or progressive income taxes from the government. It represents the total that consumers have to spend on goods and services. When disposable income increases, it means a person can either come about from a person getting a pay increase, or it can come about from the government cutting individual tax rates. It can also occur when people receive dividends or make capital gains on stock, etc., etc. Real net national disposable income is basically our disposable income, but it takes into account the terms of trade. So we'll talk about that a little bit more in the next chapter. But basically, if import prices are increasing relative to exports, that can reduce our terms of trade. And if imports are more expensive, it also reduces our real net national disposable income because the purchasing power of our income is less. But for this chapter, the key thing is be able to define disposable income and link it to aggregate demand through the consumption component of aggregate demand. Interest rates is the only other one I'll talk about in this video. Basically, changes in interest rates can impact both the micro and macro economy, so they can affect particular businesses, but they can also affect the economy as a whole. And when you're doing interest rates, it mainly affects consumption and investment. And there's two things you want to talk about within each component. So 2 reasons it affects consumption spending and 2 reasons it impacts investment spending. So first of all, with consumption spending, you're really talking about 2 different types of people. One that already have loans and 2 people that are considering taking out a loan. So for those that already have a loan, it will negatively impact their discretionary income, the income they have after paying interest, if they have a variable rate loan, which is basically one that goes up and down in accordance with interest rates. So if you have a loan already, it means you're paying more interest on your loan, and therefore you have less money available to purchase goods and services. So consumption spending falls because we're spending more to pay back our loan, and therefore we have less to spend on other goods and services. That's the first reason it reduces consumption. The second one is that when interest rates are high, people that don't have loans yet are less likely to take out a loan because they know the cost of borrowing for consumers is higher. So as a consumer, you might be more reluctant to purchase a car, purchase a house, or basically anything that's going to cause you to go into debt and have to pay higher interest rates. So first people that it affects is those that already have a loan because they have less discretionary income. The second people is that more people are more likely to save because they'll get a higher return on savings. So the opportunity cost of spending is higher. As well as the fact they don't want to be in debt because they're paying too much interest on that debt. Really important, you can link it to the opportunity cost of spending. It is higher because if you save your money, you're going to get a higher return. With investment spending, again, it's the same sort of thing. You've got the businesses who've already taken out a variable rate loan, have got less cash available to spend on like investing in new capital and equipment. So if you're paying more back towards existing loans, you've got less money to spend to grow your business, to buy new machinery, to buy new equipment, to buy new facilities, etc., etc. And the second component is that those that already don't have a loan yet would be less likely to invest because they've got to basically make more revenue from any additional investment to cover the increased interest costs of their loan. So, for example, if you've got a project that you think you're going to make a 5% return on, if interest rates are at 6%, it may not be worth you taking on that project. But if interest rates fall to 3%, you will take on that investment because the return you're going to get is higher than the interest you'll be paying. So the second component refers to those people or businesses, that are considering taking on investment projects, and they're thinking about whether it's worth taking on that project based on the change in interest rates. Thank you.